Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to CEO Shanker Patel and CFO Chris Day of Lords Group Trading, a specialist builders, merchants, and heating, plumbing products distributor. So welcome, gents.
Good morning.
Morning.
Good to be here.
Well, big congrats on today's very strong 2021 results and inline guidance for 2022. But before we sort of dig into the details, Shanker, I don't suppose you could give us a sort of like a bird's eye view of the underlying demand within the sort of the UK building products and heating, plumbing's markets, particularly given, you know, the investor worries over sort of like the economy slowing down, perhaps due to the cost of living crisis.
So, you know, what we've seen in Q1 and now coming into Q2 is still a strong industry with the markets holding up. Demand is still outpacing supply. We believe that the long-term drivers are still strong. You know, a lot of it depends around investment in real estate across the board in the UK. We all know that the property stock in the UK is not of adequate standards, especially moving forward as regulation now demands higher standards from owners and occupiers of real estate. We believe investment in property will continue. The housing market is still strong. I know there are predictions of prices coming off and prices have been extremely high, but the house builders are still building and housing transactions have not fallen off yet. And that's one of the key drivers for us. The housing transactions lead to the demand for building materials, whether it's, you know, kitchens, bathrooms, extensions, new builds, you know, any other construction material demand that comes off of a strong housing market. And as I've said before, we also see other markets developing, especially around offices, industrial units, and commercial properties, all of which are now coming under pressure to refurbish themselves, either because rents are high and landlords are willing to invest in their properties to try and get rents up, or there's regulatory pressure. Certainly the up and coming EPC requirement will force companies to look at their properties and start to invest in their physical premises, and all of that drives, again, construction materials. Not least to say that there's a continuing infrastructure investment in the UK, and again, you know, lots of companies, including ourselves, do benefit peripherally from that level of investment.
Yeah, I did see actually the latest sort of like a survey from the Construction Products Association, and it says that it still expects, or certainly expects, a strong industrial sector for like online warehouses and a strong infrastructure with like Hinkley Point and Thames Towers. How much is all that sort of commercial when you wrap that up into the business? What's a sort of like the non-residential component of sort of like of Lords Group Trading? Just roughly.
It'll be fairly small, no more than sort of, you know, 3 to 5% overall. But I don't think that's really the direct connection. It's the indirect connection that we feed off. You know, all of the, if you look at some large infrastructure projects, you know, they have a trickle down effect. You know, people either need to relocate, they need, you know, offices, premises to accommodate large infrastructure projects. And that's where we come in. We're much further down the chain and not directly involved in large projects. But certainly the whole point of these sort of large projects is the fact that the investment trickles down into many other areas. And it's not just the concentration of the project that is the prize for us. It's what it does to a local area, to a local economy, etc. And that's where we come in. So we see an indirect link, but a very strong one.
Okay. And now, Chris, I suppose you could quickly sort of take us through the main takeaways from the prelims and the Q1 sort of results, because I did see that you know, when you strip out sort of the pandemic, the business like for like basis, if you sort of exclude the acquisitions, on a sales was up sort of over 20%, which is actually about double what the industry is over that sort of 2-year period. And so obviously you've got some good, strong growth drivers there.
Yeah, as you say, I think terrific. 2021 is a terrific year for the group, with really great financial performance. Total revenue grew by 26.3% in FY21, but I think probably what was equally impressive was the EBITDA growth of 40.1% adjusted EBITDA. So we added 0.6% to our EBITDA margin, which now stands at 6.1%. And I think if you look at that in a historical context, we've added 1.2% now in the last 2 financial years, and we're confident that there's further growth through our strategy. So extended product range, network optimization, digital and accretive acquisitions.
And how much of that sort of like for like growth has been sort of split between price and volume over the last sort of 2 years?
It's a differing picture between the two divisions. So merchanting, much more pronounced. You're looking at about 50% being price and 50% volume. In P&H, it's a lot less pronounced. Maybe 5% price and the balance volume.
Right. Okay. Now, Shanker, just in terms of the supply chain, particularly sort of like in the heating and plumbing on the boiler side. Do you want to give us a quick update of how sort of like Shanker is dealing with trying to get product that he can actually sell?
Yeah, I mean, look, it's an external set of circumstances that are not in our control. One of the realizations from this is actually, you've got to get much closer to your supply chain and really be very well connected in terms of having the relationship so that you can manage the situation. We're now in a seasonally low period for plumbing and heating, so the current situation, we're looking forward to the corrective measure that our suppliers are taking, so that when the season ramps up around August to September time, we're ready for that period, and to make sure that we recover any potential lost ground. Elsewhere outside of plumbing and heating, again, the current situation is forcing distributors like ourselves and suppliers to get a lot closer to each other, and also get connected to our customer. Because what you're seeing at the moment is that you've got supply chain disruption on many fronts. Not just the product is unavailable or not available in sufficient quantities. You've also got logistics issues. Lots of people are facing container issues, lots of people are facing haulage issues, lots of people are facing labor issues. So the only thing you can do in this kind of environment is manage certain areas of your customers' requirement, so there is certainty for them, which then leads to them being able to plan accordingly to the product that's available. And that's kind of where we are. The market at the same time is, there are a lot of players, so overall stocks do exist in the market, ultimately. And I think that's another key aspect for people to remember, is that what you've got at the moment is a situation of heightened demand and an output gap. And so, the whole issue is exaggerated because of two ends having an issue. One is not a bad issue. You've got heightened demand. Everybody loves heightened demand. But the other end of the scale, where you've got an output gap because supply cannot match its previous capacity, let alone try and add capacity. And that's what's really leading to the inefficiencies and the frustrations in the marketplace. We do see that whether we like it or not, price inflation is actually helping merchants and manufacturers to withstand the financial effect of this disruptive external circumstances. And we would be in a very difficult position if price rises weren't holding and you had excess demand with the shortage of product. So that's one of these factors that are in our favor, that if this was going to happen, this is the best time for it to happen. And obviously everybody's working on trying to make sure that we get supply lines increase as much as possible. But in a lot of products, it's not easy. There's so many external forces at play here. And we're hearing, the interesting point that I see is that it moves from product group to product group. Last year it was timber. This year it's boilers. Brick has been always an issue for quite a while. Aircrete blocks have now become become an issue. Last year it was paint because you had heightened demand for paint. So it'll move through the various product areas until, of course, demand and supply match more closely. Obviously, we'd always want demand to be slightly higher than supply. But we'll see how far demand falls, if at all, given the outlook that everyone's predicting.
Yeah, and then Chris, just on the on that input cost inflation, other than sort of sales price, are there any other levers the business is pulling to manage that sort of like margin?
Well, I think we have a mixed opportunity. So there's the price of product A, but you can also change the mix and bring more of product B in, and that's a big part of our strategy, as you know, to extend that product range, and generally the extension is into higher margin products. And then the business has always been built on efficiency, so that there's always initiatives in the business to try and drive the overhead base to offset any pressure elsewhere.
Okay, and then also just Chris, I know you've done 4 acquisitions to date, which is terrific, just in the year. And I was just adding them all up, and I was getting a sort of like you've sort of, I think there's an additional turnover of about 83 million, and with about sort of 7 million of additional EBITDA, margin of about 8.4%. I think actually you bought it on about 4.4 times EBITDA if you wrap them all in together. What does that, when you put all that together against obviously what you had in terms of the sales from last year, if you assume all the businesses now have been owned for 12 months, what's the sort of like the ongoing pro forma run rate of the business? Because you did 363 million of turnover last year.
Yeah, so pro forma, if you add them all together, you're on a run rate of about 460 million,
right.
EBITDA about 29 million. So yeah, really strong step forward from those Q1 acquisitions.
Right. And I guess, Shanker, that gives you the confidence in terms of hitting this year's numbers then, doesn't it? Because if you're on a run rate of 460 million, I think the Senkos are on, I mean, admittedly, you wouldn't have all that turnover hitting into this year, but you've got sort of like 438 million of turnover for this year compared to your pro forma of a full 460.
Yes. I mean, we're as a group, we always believe in a very simple strategic logic, and that is do what you say you're going to do. And we're very pleased that the commitments that we made at the time of IPO, of what we were going to deliver in 21 and what we will be able to deliver in 2022, we're standing firm by those commitments and believe that we can deliver those commitments despite an ever-changing external environment. I think part of being a business that is entrepreneurial and operationally focused is the ability to react to external circumstances quite rapidly. So, as Chris had mentioned, we have more than just margin or sales as levers to ensure that we come to deliver what we've promised or what we've said that we're going to deliver. And operational focus and efficiencies is a big part of what we do, especially with acquisitions as well, because invariably we do find opportunities in all acquisitions around either margin, around either operational efficiencies. And the idea is to make sure that we deliver those within a sensible time frame. Acquisitions, as I've always said, are quite tricky, because what you don't want is a goodwill to walk out the door a few days after you bought the business, and the goodwill generally tends to be the people that run the business that you've just bought. So again, our strategy and our integration strategies are very, very good at ensuring stability of teams, if not the teams actually grow within a short period of time following our ownership.
Good. And
I think it's a good point. Sorry, I was going to say, I think it's a good point. The 29 million is the day one pro forma. We have a track record of improving every acquisition that we bring into the group.
Yeah. Actually, just Chris, do you want to just move your microphone a bit closer to your mouth, because you sort of like you sort of go in and out. But just on that context, in terms of sort of like improving the margins, your EBITDA, I know you've said in the statement that you're looking for over the medium term to improve it by sort of another near 1.5% up to about 7.5% from 6.1. How are you going to go about that? Is that a sort of mix of economies of scale, procurement, and route densities, and leveraging your overheads and stuff like that?
Yeah,
Chris?
it's a variety of those factors. Can you hear me okay?
Yeah, I can. Yeah, just
yeah. So I think it's a variety of factors. So product range extension is a great one for us. If you take plumbing and heating, we think there's a really good opportunity for APP wholesale to extend its radiator supply. That takes a business that's running at kind of low double-digit gross margin into a product category that averages 35 to 40% gross margin. So that's a really good example of how product range extension can drive EBITDA margin. We're focusing on the brands that we think have an opportunity to grow across and extend their geographical footprint. Mr. Central Heating is a double-digit EBITDA margin business. We're in Q3 this year. We're going to open its 10th branch. It's the first one in 10 years. We're really excited about that brand. It's national. Excuse me. It's got a national website, national next day delivery, but only 9 locations, and we think there could be many more across the UK.
Good. And then more broadly on the top line, Shanker, I know we chatted last time, and I think you put it into there. You've got sort of like a target medium term of about 500 million of revenue, but given you're on a pro forma of about 460 currently, and you like stretching targets. Do you want to give us a view on when you think you might be able to achieve the 500, or is it still sort of like medium term? Let's see how the market goes. I don't want to sort of like raise the bar too much.
No, look, you can't be entrepreneurial and not make bold statements that probably most people would advise you not to make. The truth of the matter is that our intention is to meet our 500 million target ahead of time, right? Obviously, we can't control the environment, etc. But we are confident that we will be able to meet this ahead of the timeline that we've set ourselves. But I'm also a firm believer that before we can move to being a bit too jubilant about our abilities and too confident and hubris sets in, the best way to look at the near term or the medium term following meeting that target is, as we approach it, we will start to revisit what are our strategic options given our strategies and given our scale, and what would then be the next target that we feel we're confident to achieve. Let alone, all of this is underpinned by the fact that we are a growth organization, right? 30 years of history tells you that this organization doesn't like anything. It doesn't like it when it's not growing, and growth is very much part of our DNA. But it's always controlled. It's always financially stable in how we deliver it, and it's sustainable. So the next target will have to be a sustainable target, not one that we push and strive towards, but may be so much of a stretch that it actually destabilizes the business or opens us up to risk that we shouldn't really be taking. So it'll be a revisiting of the target as we get line of sight to hitting our current stated target ahead of time.
Great. And then just finally, Chris, in terms of sort of like news flow going forward, I'm guessing we've got the sort of the AGM coming up at some point, or a half-year trading update.
Yeah, so we have AGM on the 29th of June, and then H1 results will be published in September.
Brilliant. Okay, well, thanks very much, gents. Cracking set of results. Good good reiteration of the guidance as well, and yeah, I mean the acquisitions seem to be bedding down well, so all ship shape and going well, I guess.
Yeah, well, look, 1 year down, now coming up to a year of being a listed business, we are very pleased with our performance. We're hopefully also delivering to our key stakeholders, our shareholders and employees, what we said we would. And we look forward to the support of being able to deliver more in the coming years.
Brilliant. Well, thanks for your time, guys, and let's look forward in touching base for the half year.
Thanks, Paul.